Federal Reserve Chair Janet Yellen, who's stealing the spotlight for our business viewers. So let's bring in two guys who are on very different ends of the economic spectrum, who are listening to every word. Andy Brenner is National Alliance Global Strategist and head of fixed income. He says that we are on track for 2, maybe up to 3 rate hikes this year. And Peter Schiff, Euro Pacific Capital President. Peter is saying that the Fed will be forced not to hike, but to cut. All right, let's get to it, Peter. Why? We're looking at the fact that you believe we might be about to tip into recession, but really, to cut rates?
Yeah, well, first of all, it's 2 rate hikes down, 2 to go. I said at the beginning of the year, I didn't think the Fed would raise rates 4 times. In fact, I think there's a better probability that they will reduce rates back to 0
this year?
This year, than notch them up again. I think the Fed is still oblivious to the fact that the U.S. economy is back in recession. Now, maybe the Fed knows this and just doesn't want to acknowledge it because they don't want to be accused by President Obama of peddling fiction. But the fact is that the U.S. economy is in horrible shape. You're talking about the elections. Why do you think Donald Trump is getting so many votes? All the exit polls show that the #1 concern facing voters is the economy. Yet Janet Yellen said that consumers are confident. No, they're not. Those consumers are voters, and they're voting for Trump because they're not confident.
Andy, you say the complete opposite. You say 2, but possibly even 3 rate hikes. Why?
Well, first of all, I'm going to limit it to 2 because if you look at all the numbers, the unemployment number, you had 242,000 jobs added this past month. You had 500,000 household employment increase. You've got the lowest weekly jobless claims that you've had in 40 years. The economy's not doing great. In that respect, Peter's right. But the GDP is stumbling along. I got the Atlanta Fed GDP update today, 1.9. There's no question that the economy is stumbling along. And what you saw today, basically, with the Fed backing off, you saw a massive steepening of the yield curve. You saw a weakening of the dollar. You saw an increase in gold. And that's all supposed to happen just like that.
It's supposed to be stimulative.
Right, as the Fed backs away. And I think the bigger bazooka was by far and away the European Central Bank, what they did on Thursday, by buying corporates and by then allowing banks to have unlimited sources to lend to consumers and to corporations, but not for mortgages. It's going to stimulate the Eurozone. It's going to allow the Fed to raise, and you're going to have 2 rate raises, more than likely June and December.
If the Fed was going to raise rates, they'd have done it today. Look, if the Fed has to know...
not. There's no way the Fed was going to do it today. The market wasn't anticipating it. It had next to 0 interest rates.
The Fed
There's no way they were going to raise
today. The Fed doesn't say they're market dependent. They claim to be data dependent. And if the unemployment rate is really as low as you claim and we're creating all these jobs, look at the core inflation numbers that came out today. Core year-over-year core inflation up 2.3%, above the Fed's so-called 2% target. So I believe that Yellen knows those numbers are bogus. Yes, we created a bunch of jobs last month. 90% of those jobs were part-time jobs. These are lousy jobs. These are low-paying jobs. These are Trump voters. These are Sanders voters. That's why they're there, because they have a part-time job and it's lousy and the pay is lousy. 80% of these jobs are service sector jobs. Many of them are minimum wage jobs. You can't raise a family on these jobs. Many kids can't even move out of their parents' house if they can't get a job.
So, Andy, oil roared today. Gold is moving higher.
Absolutely.
What should the investor do right now if they can make some money here?
Listen, what I like is I like U.S. corporate bonds. I really think they make sense. If you can get anywhere from 4 to 6% on good bonds, on AA or single A related bonds, I think you should look and lock that in. Because even though I do think the Fed's going to raise rates twice, I don't really think rates get away from us. Your 10-year is 193 right now. I don't think it really breaks out of a range of, say, 175
yeah, so
to
Peter,
250.
why not go into corporates?
So I think it's a conservative way.
Why not go into corporates that give you 4 to 7%?
Because rates aren't going to go up, but inflation will, and inflation is going to be a lot higher than 4%. I wouldn't want to throw my money away. I want to own real inflation protection. Look at the price of gold going up today. It's going a lot higher, but you also want to invest outside the U.S. Look at the U.S. dollar index plunging today below 96. This is the weakest it's been all year. The dollar is falling across the board, and that is going to produce spectacular returns outside the United States. So if you want to buy corporate bonds, look for companies that are going to pay you in a currency that's not going to go down. But I would rather invest in dividend-paying foreign stocks in countries that are going to see substantial appreciation against the dollar, but also where the countries have much better macroeconomic.
Quickly, give me your favorite country. Your favorite country. One quick sec.
I like New Zealand, like Switzerland, Singapore. Those are a few.
Okay. Last word. Go ahead, Andy.
You know, emerging market in local currencies has been a disaster the last couple of years. I would keep it in the dollar. I would look to possibly actually keep it in the dollar. I'm going to leave it there.
Okay, great to see both of you. But right now, stocks are making money. We have the Dow up about 112 points. Thanks to Peter. Thanks.